Ladies and gentlemen, next we will turn the biggest picture. These panels brings together leading analysts, portfolio managers, and senior executives to discuss how they're positioning through wars, policy shifts, and AI-driven market change. Please join me to welcome our all-star macro panel, Opportunities in the Storm. Right here leading these conversations is Pakama Bangiso, Advice Manager at Old Mutual South Africa. Ladies and gentlemen, if you are ready, please give our session a warm welcome.
Okay, thank you. Good morning, everyone. My name is Pakama Bangiso. I'm an advice manager at Old Mutual, focusing on distribution enablement. Today's discussion comes at a very interesting time in the markets, shaped by geopolitical uncertainty, shifting interest rate cycles, and the rapid rise of AI. Today is about unpacking how those forces are influencing performance, portfolio decisions, and where the most compelling opportunities may lie. I'm joined by an excellent panel with me, and I'll give them an opportunity to introduce themselves.
Can you hear me? There we go. Hello there, my name is Lawrence Reichert. I am the head for Africa for Holborn. Thank you.
Good afternoon. My name is Francois Strydom. I'm the head of portfolio management for Momentum Securities in Johannesburg.
There we go. Okay. So my name is Francois as well. My name is Francois Duplessis. I am the senior market analyst for ATFX Africa.
Good morning. Kobus Potgieter, CIO portfolio manager at Southern Cross Capital.
Hi everyone. I'm Adam Bulkin. I'm from Edify Invest. Edify is a discretionary fund manager. That's a manager that manages clients' assets on a discretionary basis, usually for financial advisors and brokers.
Zander van der Merwe, Head of Sales and Key Individual at TD Markets.
Okay, thank you very much. Let's get into it, and let's start with Francois Strydom. So what were the performance drivers in 2025 for equities? So looking at both global equities and South African equities.
So I think if we start locally, if you just look at the constituents of the JSE, more than 50% resources and very interest rate sensitive stocks, especially financial stocks like banks. And if we start the beginning of last year, you remember there was a continuation of a diversification away from the US dollar into gold by many of the central banks globally. And at the same time, you also had, rates globally coming off. So there was definitely a strong impetus on bonds and interest rate sensitive stocks to revalue. But at the same time, if you've got a continuous lowering of US or global rates, obviously the opportunity cost of holding gold decreases, and as the gold price rallied, so also did the gold stocks on the JSE. So if you put that perfect Goldilocks environment together, you've got a very strong cyclical trend in terms of banks, bonds, and the resources doing an incredible rally, right? Globally, more so, you looked at Japan, you looked at Europe, they were exceptionally cheap. The safety margins in the Nikkei in terms of where the 10-year Japanese bond was trading and where the earnings yield on Japanese equities were trading, those were massive safety margins. So globally, Japan and Europe just look exceptionally cheap. The US, that was primarily driven by these AI big spending events. And although earnings was resilient, it wasn't the massive earnings growth that we saw as beginning of this year. So
Okay.
those were the primary drivers last year.
All right, thank you. And looking into this year, is performance still driven by the same drivers, or are you seeing a different view?
I think locally, the cyclical element's obvious, right? So that could be a bit derailed by, inflation and the risk of inflation becoming more long-term. Because the moment inflation starts creeping in, it becomes settled, interest rates are bound to go higher, and that's not great for the cyclical trade. From a fundamental point of view, or structurally, you've got let's say, an energy and a transport, environment, that reform isn't happening. It's stable, but it's not really, it's not like we're sitting with a massive output gap or, an energy that's unutilized in South Africa or transport that's not being utilized. So that's a bit of a structural negative locally. At least from a fiscal premium or a fiscal stance, that's very positive. Moody's just recently put us on a positive rating, so on the way there. And then if you look at long-term valuations on the JSE, we're still below long-term mean. So it's not a structurally a massive positive, but structurally also there's things that could be improved on. Offshore, you're still sitting with Japanese equities that are cheap relative to the rest. Earnings out of the last earnings season out of the US were phenomenal. I mean, we didn't expect the earnings growth to be the way that it was. The big weight in the system, was NVIDIA, that gave the AOK, and all of this was just ignoring all the noise happening, in terms of the inflation front and obviously oil and energy dynamics.
All right, thank you very much. Moving on to Adam. As a DFM building model portfolios for clients, how are you adjusting asset allocation fund managers in response to this macroeconomic environment?
So it's very tempting to try and shift asset allocation according to one sees in the macro environment. Unfortunately, the empirical evidence suggests that it's actually very difficult to time the market, and there's that old adage, more time in the market than timing the market. And unfortunately, although tempting to try and shift dramatically asset allocation, truth is that once you have a strategic asset allocation, the best thing to do is actually to keep with that asset allocation, to keep with your investment program. You can make some small shifts, but often, even if you are able to correctly predict what is going to happen in the macro environment, it's very hard to predict what the secondary effects of that will be. And so even if you can predict what inflation or GDP or currencies will do, the market often predicts that with you. And so any active allocation changes you make aren't often rewarded. So to answer the question succinctly, I tend to advise clients to keep with their strategic asset allocation, not to make too many rapid shifts. All of that said, I mean, I think, certainly in the US, equity markets are fully priced. Inflation is becoming a concern globally. And overall, I would suggest going lower duration, more into cash than into high duration bonds. I think high duration bonds are unlikely to provide protection in a very inflationary environment. And I think shorter dated bonds will give you a bit more protection. Emerging markets, Japan, other markets looking a bit more attractive in terms of valuation. So I would probably suggest becoming slightly more defensive, slightly lower duration, but overall keep with one strategic asset allocation.
All right, thank you. In your asset allocation, how do you weigh the role of commodities or precious metals?
So with commodities, particularly with the South African market, one is naturally exposed to resources quite heavily because a large part of our market, our equity market certainly, is exposed to platinum miners and to gold miners. And so from a South African perspective, though it's tempting, given how well gold has done, to increase one's allocation to gold particularly and the PGMs from a physical metal perspective, actually one has a lot of natural exposure through the stock market to resources. Again, I would say holding commodities, especially gold, one needs to make a decision as to whether one's a strategic holder of that or not. It's very difficult to predict the price of the physical. Sometimes huge geopolitical shocks like the one we've just seen aren't followed by an increase in gold, which one would have thought would have happened. And that's because of the huge speculative increase in the gold price prior to that. So it actually sold off, which is surprising. That's an illustrative point of the fact that it's difficult to predict. I see it as more of an uncorrelated asset, an asset that one should have in one's asset mix at a strategic level without trying to be too smart in terms of being able to predict how it's going to behave in any particular environment.
All right. Thank you very much, Adam. Moving to Cobus. As a hedge fund manager with the ability to move across asset classes, where are you currently finding asymmetric opportunities, and where are you cutting risk given this macroeconomic environment?
I guess I hate to reiterate what Francois and Adam have just said, but essentially sharing the same view that we are quite bullish South African equity SA Inc. specifically. I think the thesis hasn't played out fully. The stocks are historically cheap, and those green shoots is sort of the recovery thesis, hypothesis that we saw starting to play out last year, that hasn't been extinguished entirely by the high inflationary environment. And certainly on a relative basis, relative to the valuations we are seeing in developed markets, the value here is still incredible. And we like the sort of, call it governance development, with the continued success of the GNU. And frankly, I think we're all a little bit concerned about the transition in power in government or in the ruling party specifically. But this is actually incredibly healthy from a governance perspective. Even if there is short-term disruption, it's pain we have to go through as a young democracy. It's an evolution we have to go through, and small party politics or coalition politics will be tricky, but ultimately will be better for the rating and equity, better for consumer confidence, better for foreign direct investment. And we remain quite constructive on SA equity, other than those driven by these big macro components like resources that Adam's already covered. We are, given that the exogenous shock introduced by the Iranian conflict is likely to keep pushing inflation for longer than was anticipated, quite bearish global fixed income. And we think that sort of dollar debasement and essentially we're talking a balance sheet that is becoming more and more unsustainable in the US. So we expect those long-term rates to keep feeling that upside pressure over time. In this environment, you would typically expect that to have reverted. To go, the flight to safety should have narrowed yields, and the opposite has actually occurred because this war is so expensive. So global equity probably neutral. Not underweight there. I'm not too concerned about the air bubble yet. Earnings have been robust. We are still long global equity. We're certainly highly convicted on SA equity, and I'd say neutral on SA bonds, but underweight global bonds or developed market bonds.
Okay, all right. Thank you. So what would you say are some of the pros of investing in hedge funds? What role do hedge funds play in an investor's portfolio?
Okay, so South African hedge funds all come out of the institutional space. They're incredibly niche. And even though I'm speaking on a global macro panel, there aren't really any global macro hedge funds amongst the reputable players locally. But if you combine them all into one, I suppose you could consider it sort of a global macro view being expressed. So the role of hedge funds historically has been to protect you the downside and create some upside volatility. Some upside in volatile environments. And that is something that the hedge funds have certainly excelled at. Our market is relatively unique in that it is a developing economy with an inefficient market, but a very, very sophisticated financial system, which means that our active managers more broadly, and I suppose, the average trader has been able to generate better returns, better alpha than you would find in developed economies and developed markets that are much deeper, much more efficiently priced. So inefficient markets create opportunity, and the managers can exploit that. And frankly, given things like the financial crisis, in 2008, COVID, taper tantrum, call it the sell-off in technology stocks in 2022, as well as this conflicted environment. Now, we've actually seen those managers remain defensive, some of them even generating returns in that environment. And what happens in that instance is because you haven't suffered that drawdown, you can now participate more fully on the upside as an allocator. So that is sort of the role that a hedge fund, to my mind, really plays in your portfolio. It gives you uncorrelated returns, it gives you protection in these tricky markets, and it allows you more flexibility when the pawpaw does hit the fan, because now I haven't sustained these enormous drawdowns and I can continue with my asset allocation and my strategy without being distressed or making any panic moves or trying to time the market disproportionately.
Okay, all right. Thank you very much. Moving to Lawrence. At Holborn Assets, you are allocating across different asset classes for high net worth clients. In this current climate, how are you recalibrating your strategic asset allocation in terms of offshore exposure, currency diversification, and maybe capital preservation?
So for us, the one of the biggest dangers has been the rise of the exchange-traded fund that just tracks an index. That has beaten just about every developed market manager, really. But that index is suffering such massive concentration risk, and it continues to suffer concentration risk, that at some point the active managers are going to start picking their winners, and I think that one of our biggest strategic moves is to get away from just tracking markets and moving into these guys so that they can go and pick their winners. The other issue, of course, as everybody's mentioned, you've got these massive valuations overseas. It's not if, it's when. It's going to come down, and you have to have a defensive position. You have to have guys that have taken some profit already. You have to have the hedge fund guys. You have to have some structured solutions in a portfolio to battle that, and you have to have uncorrelated returns. So we are very, very pro the hedge fund guys. We're also short global bonds. We like domestic credit. We like foreign private credit, not at the high space that is advertised in the US, much lower down the cap space, and some structured products inside of a portfolio generally should give us relatively good run. If 20-30% of a portfolio is going to give us 7-8% return in dollars regardless, you can take the knocks, and the hedge fund guys essentially should take less of a knock than anybody else. So we're pro alternatives in our portfolio, and we're really mindful of concentration risk right now.
Okay. So what would you say are some of the most interesting conversations you have with clients currently? Are they seeking opportunities? Do they want to diversify, or is there a bit of fear in terms of how the market is doing?
It's a different conversation that these guys have than we have. So we sit at the coalface with a client, and we talk to them about having a little bit of everything, diversified portfolio, and all they see is this index that just rally and rally and rally, and you have to educate that client. Look, you can't just chase that dragon all the time. You're going to get too high and then it's going to come down. Problem with clients in general is they are very backward looking, and so what they'll do is they'll say, I see this thing going up. If I speak to one more client that wants SpaceX, I'm going to throw up. So all they do is they just see these things that massively go up. They needed to be in it, private equity, a year ago in order to get those massive moves. So the conversations that we're having with clients is have a risk measured approach to this. What are your income needs? And is that part of the portfolio looking after your income needs? Because if you're going to chase that dragon, it's going to come off by 40 or 50% if it really tanks hard. And then you have half the money left, and we can't pay you an income with that. So for the traders in the crowd, I'll just warn you: do not just go chase the dragon. You're going to have to find a new dragon somewhere. Our conversation generally with clients is don't just put all your eggs in one basket, especially in this environment. And the problem is the AI bubble, which is not yet a bubble or whatever, it's the gift that keeps on giving. So it just keeps going. And if you're not participating to this, your clients are going to get angry. So you have to have some of that in the portfolio, knowing that it's probably going to slide on that client at some point. But you have to have it, because if you don't, they're going to go to a competitor that will service them for that. Our job is just to make sure we shove some alternatives in the mix, make sure that they're not overly exposed to just one thing.
So on. Okay, thank you. Moving to Francois Duplessis. Given your view across FX commodities and indices on the ATFX trading platform, how are markets currently pricing geopolitical risk? Is it being fully reflected in currencies, commodities, etc.?
So I think in that regard, the answer is not as straightforward. Okay, so yes, risk is reflecting, but it is reflecting differently in various assets. So if we have a look, for instance, in commodities, risk has been very present as of late. I mean, we have seen the volatility in oil, we have seen the rise in gold as well, but even then the major drop that followed after that. So in that essence, yes, risk is relatively present in that regard. But then when we start having a look at things like currencies, for instance, it's not as black and white anymore. I mean, if we have a look at the US dollar, for instance, yes, the US dollar can benefit from safe haven demand, similar than gold does. However, then oil price goes up and then inflation risk appears and so forth. And now you have to start allocating in what possible Fed decisions could follow because of that. And that then changes the picture completely. And even speaking about currencies, even if we have a look at, for instance, the Rand, now when we have a look at our local currency as well, it's kind of stuck somewhere in the middle. Because yes, it is benefiting from a weaker dollar, and yes, it is benefiting from stronger precious metal prices and so forth. But what happens when that coin flips and we start getting a weaker price on gold and our exports decrease on that side as well? Even if we're having a look at, for instance, the oil prices at the moment. I mean, South Africa, we are not an energy producing nation. So on that end, inflation risk for us is a big concern. And that can definitely, again, now affect our local currency. And again, the dollar is also playing a major factor here as well. So as I was saying, when we have a look at the various assets, it's not the same answer across the board. And I mean, even as some of my fellow panelists mentioned regarding equities, even when you have a look at equity risk at the moment, it's very selective right now. So we have some indices, and especially if we're having a look at the S&P 500 and NASDAQ, it just looks like it has no end right now. It's just keeping on going and going. But again, there are other factors that we need to have a look at, and that could truly affect market evaluations, especially in the near term.
Okay, thank you. I'd like us to focus on the Rand, on our local currency. So they opened 2026 at its strongest levels since 2022. So what would you say the outlook is on the Rand?
So we definitely did have a great start to the year. So, and I would say my outlook currently on the Rand would be relatively cautious because of the fact that, as I stated a little bit earlier, yes, we are benefiting from a weaker dollar. Yes, we are benefiting from elevated precious metal prices and so forth as well. But once that scenario starts changing a little bit, it could really affect our local currency standing the way it is right now as well. And also, we have to take into consideration that as of late, there's been a lot of additional trust that is being placed in South Africa as a developing nation. It is attracting more foreign investors and so forth as well. So even from a government perspective, if we can keep that going, definitely we could have additional bullish momentum on the Rand as we are seeing it at the moment. But yes, I would still keep my outlook currently, based on where we are right now, to relatively cautious.
Cautious. All right. Thank you very much. Moving on to Zander. Given your visibility on client positions, how has the market volatility changed investor behavior on your platform? Are clients becoming more defensive? Are they leaning into the volatility as an opportunity?
Yeah, it's one of those 50-50s in a way. From a high net worth end, like most of those clients are leaning a little more to the defensive part, like not as intensive. The increase in volatility that we've seen across all of the commodities has very much put people onto the risk scaling down a lot. So what we've been seeing a lot happening from our higher net worth clients is we've been scaling a lot more down on the volatility side just because their risk exposure gets a lot more bigger.
Okay.
So that inverse or that negative correlation that's been seen between like gold and oil has sort of been driving a lot of where all of our higher end investors were sitting. But on the flip side of that, if you look more from the retail investor side or retail trader side, this is more where that volatility can be exploited a lot more. So where someone doesn't have a lot of money and they can sort of do their research and look at where the volatility aspects are driving the markets, that's where we see like a lot of our smaller investors or smaller traders actually like put more into the markets, and that's where like a lot more volume is being pushed through.
Okay. All right. Thank you. So where do you see that the most opportunities lie currently? And also, where would you say your most crowded trades are, both for the smaller clients and sort of the more high-end clients?
So I think most of the movements in the markets has happened significantly at the moment. Where I feel like a big factor is still on that inflation, on the inflation side. And I still think there's going to be like a lot more equity upside coming in over the course of the year. The big factor that I'm looking out for at the moment is when stagflation sort of hits the market, and that's when I want to see where the market sort of reacts after that GDP growth and the inflation doesn't really balance out against each other. So it's not really an answer, but that's sort of what I'm looking out for at the moment from the next sort of a cycle in the market at the moment.
Okay. And in terms of where investors, are trading, where would you say the most crowded trades are?
Always gold.
Okay. All right. Thank you very much. So we'll move back to Francois. Lawrence also spoke a bit on the AI stocks. In the past couple of years, performance have been driven by the magnificent 7. So is that the same thing as the AI stocks, or are those different things?
Definitely not the same thing. So not synonymous with AI and Mag 7, definitely not. I think if you were to pick leaders in the Mag 7, it would probably be NVIDIA, who's obviously the semiconductor supplier, the enabler. Otherwise, Alphabet, who's a big AI builder, probably the most likely listed company to also monetize what they're building in the short term. And I think that's the big risk for us is where does the monetization start happening? Where does the cash flow come through, and where does it end up supporting this valuation? The big laggards, well, not laggards, but the more disappointing ones being Amazon and Microsoft. Their sort of cloud computing, web services, and Azure, huge growth engines in the past, and those are just being absolutely left behind in the scale of things. So no, Mag 7 definitely not anymore. We always looked at Mag 7 as a theme, not necessarily picking those 7, but the theme of growth, and not necessarily growth just because of a PE valuation, but observable growth. Who's spending on R&D? Who's actually creating earnings growth that's reliable or comparable to cash flow? That comparable growth, and that was our theme that we've always looked at. And you'd be surprised what sort of names, especially in the emerging market space, you come up with.
Okay, thank you. Would you say we are in an AI bubble currently?
Would I say we're in an AI bubble?
Yes, currently.
Yes, it's hard to say. It's really hard to say. I think Anthropic is actually showing some profits at the moment, right? So that's probably going to be one of the most anticipated listings in my opinion. We are definitely in some space bubble of some sort. You know, $2 trillion valuation just doesn't make sense for something that's, you know, making a $4.5 billion loss. And even if they didn't spend the $3.5 billion on R&D, they still would have made a loss. So from that perspective, there's a lot of hype. And all of these anecdotal sort of evidence points say, yes, there's a lot of hype going out there. We're using the short-term trading metrics as sort of a sign to say, well, let's take a bit of that heat off the table, right? And when the volatility does come, we've got other than just market timing ways of making use of it.
Okay, all right, thank you. I'd like to move to Adam. Do you think there will be a ceasefire with the war? And how do we expect market to react should the current war go on longer?
So if I really knew the answer to that, I wouldn't be sitting on the stage. I'd be trading with you guys successfully. But I think there's certainly an incentive from both sides, from both Iran's side and from the US's side, to sorry, I'm competing with the lady outside a bit there. There's certainly an incentive from both sides to reach some kind of resolution. Our expectation is that there will be a settlement. It will be a messy settlement. It won't be a very clear-cut settlement. That it will be reached fairly soon. I think there's a pressure on both sides and from the rest of the geopolitical blocks, you know, with oil being under pressure. Excuse me. So it's likely that there will be.
Sorry.
It's likely that there will be a resolution fairly soon. How the market is likely to react, there is a probability that oil price could reduce quite significantly. The Gulf states are incentivized to increase the supply of oil. They want to punish Iran for the attacks that have been made by Iran against them. Obviously, there will be kind of like a global expectation of oil to come down, and that expectation itself will drive the price of oil down. So in the short term, you'd probably see oil coming down a bit. You'd see the inflation concerns reducing a little bit, even though there have been supply pressures that have been building up, which might cause actual goods supplies to be bottlenecked and therefore cause some inflation in the short term. The longer term inflation expectations might actually be reduced. And you certainly see somewhat of a sentiment uplift as whatever concerns there are that the war is still grinding on come to an end. So all in all, we'd probably see inflation expectations coming down, risk sentiment coming up, and a bit of a risk rally, equity markets improving. And we do think the incentives are there for that to happen.
Okay, all right, thank you. In the interest of time, I think that's a great note to end on. I'd like to give an opportunity to the panel, each person, to sort of like share where clients can look for opportunities in this current market. So I'll start with Lawrence.
Yeah, as mentioned before, I think the volatility creates opportunity in itself. So I don't think that you need to stay away from it. You just need to not be all in one thing. I think the market has an interesting way of, no matter what any of us predict, including Warren Buffett, we simply don't know. So don't just back one horse, as I said. I think what will happen in the US is Donald Trump's going to start retreating back to the US, and he's going to become way more US focused now, going towards the midterms. He has got to pick his approval rating up if he wants to win the midterms. He cannot go home with saying, I've just got war and blood on my hands. The narrative has got to change if he wants to win the midterms. So I think he would want to say, look at our economy, look at how wonderful it is. He would probably want to say, look at the gas price coming down. Interesting thing about the gas price in the US is about $4.20 a gallon. They were there in 2020. It's the only country in the world that was that has the same gas price now than in 2020. Every other country is higher, and I think he'll use that as pulpitting. But he has to show that that inflation is not running away with people. People can afford things. His big, beautiful bill is starting to come through. There needs to be more money in the pockets of Americans. So his rhetoric is going to be very important going into H2 of the year. And generally, that if the noise is, don't worry, we've got inflation. Don't worry, your fuel price is coming down, and we're going to give you some tax incentive. It increases spending, and the U.S. is a spending economy. So I actually think the U.S. in H2 is going to do well. But like I said, don't just back one thing.
All right, thank you.
Those who follow us in our morning meetings or our macro updates, they would know we don't mind volatility, right? Volatility is actually very good for any broker or stockbroker out there. Don't be fooled. But for a client in a long-term portfolio, what we love to do is scrape off some of the volatility and defined returns, right? So we'll do reverse convertibles. Come and chat to me afterwards if you want to find out what that is. Reverse convertibles or auto calls.
I have no idea what that is.
Right. So it's basically simple equity positions that we literally just sell the volatility out, and we hold those, that we scrape that volatility into a client's portfolio, and it's a lovely yield enhancement in times of volatility, right? So instead of a client sitting in cash, right, you can hold these positions and get a bit of a yield pickup. It's not more risky than equity. It's not more risky than a hedge fund. It just diversifies the return. So the correlation between that component in the portfolio versus the rest is very low. So that's the one thing. We love volatility for that reason. The other thing that I'm really looking forward to is CPI plus 5 returns in SA bonds again, right? That's going to be a reality somewhere in the next 12 months. Mm-hmm. If you can give a client that's drawing income a CPI plus 4-5 return, with very little risk, that's a no-brainer. You can build on that. So those are the two elements I'm probably looking forward to the most.
All right, thank you very much.
Well, I think I'm going to keep the theme going with I love volatility. So, I mean, I honestly think that is currently our biggest opportunity. And slightly different to the two panelists to my right, obviously, in ATFX, our focus is more reliant on CFD trading. So it's a lot more short-term, a lot more fluctuation within the market. So with that, volatility would still be my biggest opportunity right now. And if we have a look at assets like gold and oil, and even having a look at some of the indices, yes, even though they are way overvalued right now, there is still a lot of downside potential on that as well. So there is definitely a lot of opportunity in that regard. But building on what Lauren said as well, with everything that is going on, especially within the US and so forth, and especially, as we know, Trump's ability to send out one tweet and change markets, your edge within the market is also going to be with how well you stay up to date with everything that is going on within the market at the moment, because of the fact that if you get caught on the wrong side, as great of an opportunity as volatility can be, it could be your end.
All right, thank you.
Okay, let's talk volatility then. Sell my own book, how we exploit the volatility, and this environment is fantastic. For that is we have what we call corporate structure arbitrage. That is any situation where I can invest into the same opportunity through more than one avenue. Which means effectively I can purchase the cheaper component and short the more expensive component or components. And that, you can imagine when Trump is sending a truth or a tweet or whatever you want to call it, this contradicts to the news we're getting from Hormuz. There's a lot of disconnect, and that creates enormous opportunity for us, and that's where we end up focusing a lot of our efforts during environments that are like we are currently experiencing. Perhaps a little bit more specialist, but I mean, just to demonstrate how we play the volatility in the space. More practically speaking, and maybe a little bit more long term, your defensive equity stocks have been stellar performers in this environment. You will be, I mean, people forget about these things during AI bubbles and the like, but go look at AB InBev, go look at British American Tobacco. These are blue chip, staple stocks with stable cash generation and fantastic management teams. They are managed to perfection. I mean, they from all the way from the top down, these things are just designed to be capital efficient and generate maximum return for shareholders. So they are boring. They don't have the most amazing growth prospects, but they are fantastic holds in an uncertain environment. And in this environment, you will typically see multiple expansion in the ratings on those stocks. And then finally, just to reiterate the opportunity in local bonds, say what you like about the SARB's policy, it is credible. When they say they are going to do something, that is what they do. And this new interest rate or inflation target, they will be enforcing that, which means rates will remain high for longer regardless of the inflationary outlook, simply because it is clear in terms of the settlements we are seeing with the unions, wage settlements in particular, 7%. This is way in excess of our target inflation of 3%. It will take time for that to happen. As it happens, you will see a shift in the discount rates locally, and similar to what we saw in the early 2000s when the credibility of the new monetary policy was established, that led to a permanent re-rating. In the meantime, you've got the opportunity to lock in incredibly attractive real returns, which will be realized in time. So we are, on that basis, really still quite bullish local fixed income, tapered somewhat by the expectation for higher inflation being introduced by this exogenous shock. But more typically, we think the macro theme is further strengthening of South African fixed income.
All right, thank you.
In the interest of time, I'm just going to choose one particular strategy, global quality. I think global quality stocks have been sold down significantly. They've underperformed last year, the most that they underperformed relative to other stocks over the last probably 20, 30 years. Apart from the fact that they've underperformed, so that they're selling at cheaper values, they offer resilience. If we do have a downturn, it's still equity, so in an equity market, they're still going to produce upside. And in terms of inflationary concerns, their business model is generally able to withstand inflationary pressures, pass on those inflationary pressures in terms of their margins onto consumers. So one particular asset class that I'm interested in, global quality.
I think it's important, if you want to talk about the opportunities, you need to sort of touch on all the risks that's out there at the moment. I think private credit is still like a big factor at the moment that's out there that hasn't quite hit the market as efficiently as it should. So I think that's still going to come into the market. Similar how we should see how the Iraq war is going to play out as well. So seeing that, I mentioned it earlier, like that negative correlation between gold and oil, as soon as it starts changing, that's when you want to start looking at buying gold quite aggressively, because I think there's going to be a lot more upside coming in. All of these other risk factors added into it, I think, is still holding gold back a lot. So I think there's going to be a significant amount of upside on gold as current reserve banks sort of build their gold reserves as well and sort of pulls it in. Like, obviously, running off of what Francois said, like during his talk as well, as I think that's going to aid the rand a lot. So we're going to we should see like a lot of rand strength come into the market over the next year or two.
All right. Thank you very much, Sander. Thank you to our panel for sharing such valuable insights. In the interest of time, we're not going to be able to do a Q&A session, but please do find our panelists throughout the conference to continue the conversation and to connect with them. Please join me in thanking our panel.